We've got a great panel this morning, and I now have the pleasure of introducing our panelists who are going to be covering global tax policy and global tax controversy and dispute resolution. Making the trip all the way over from Europe is John Preston. John is a chartered accountant and a partner based in the London office of PwC. He's our global leader for tax policy, external relations, and regulation, and a member of our global tax leadership team. In his role, John has overall responsibility for the PwC Global Network's relationships with all external third-party stakeholders, including governments, revenue authorities, ministries of finance, among others. And John has held a number of other senior roles for PwC in the UK, including as PwC Financial Services Tax Leader. John's main practice area is financial services, with a particular focus on banks and asset managers. David Swenson is a principal in the PwC Washington National Tax Services practice and is based in our Washington, D.C. office. David is the global leader for PwC's Tax Controversy and Dispute Resolution Network. He's a lawyer, a frequent speaker, and an adjunct professor at Georgetown University. David is recognized as one of the top 5 tax controversy experts in the U.S., one of the top 20 tax attorneys in the U.S., in the area of tax litigation, and one of the world's top 25 TP specialists. And no, David did not pay me to say that. Prior to joining PwC, David was an international tax partner with a large law firm for over 20 years, and he has participated over the years in more than 250 tax controversies involving disputes between multinationals, the IRS, revenue authorities in more than 24 countries. And I'll also add that David has either won at trial or favorably settled virtually all of the tax cases he's participated in. Moderating today's discussion is Mark Vaness, who's based in Ottawa, and Mark is the leader of PwC Canada's Tax Controversy and Dispute Resolution team. Mark brings today his experience in many areas of Canadian income tax, gained from over 26 years in public and private practice, including over 20 years in the Income Tax Rulings Directorate of the CRA. He was Director of the Reorganizations and Resources Division at Rulings, Director of the Business and Partnerships Division. He was a member of the CRA GAR Committee, and there are a number of others, but I'll mention that he was a member of the Technical Committee on Business Taxation, the MINTS Committee. Almost done. Mark has worked with the Department of Finance on numerous legislative changes, including tax shelters, partnerships, among other areas. So this is going to be a very interesting discussion this morning, and I know we all look forward to hearing about other tax jurisdictions and what may be surfacing as global trending around tax policy and dispute resolution. So again, on behalf of PwC, thank you for being with us today. Please enjoy your day. I look forward to speaking with many of you throughout the day, and I'm going to turn it over now to Mark.
I have really the pleasure of having, I think, 2 of our top people in the firm, one on tax policy, one on tax controversy this morning. I have the easy role. I'm just the moderator. I feed them a bit of questions. I make sure that they stay on time. That's going to be my biggest task today, to keep these guys on time. And how I see the next 75 minutes evolving, I'm going to have a conversation with John on my far left on tax policy for about a half an hour or so. And at halftime, I'm going to flip over with David. I encourage John and David to interrupt at any time. We want to make this really a very open fire chat conversation. So if I just move and get down to business, because I really want to hear these guys speak. I've been with these guys for the last 2 days, and they have so much insight in their respective expertise. John, what I thought in our next 30 minutes or so, I think I'm going to touch on 2 broad categories. I want to touch on tax avoidance, and I also want to have your views on tax policy. So if I take tax avoidance, in Canada, tax avoidance is acceptable provided it's in line with tax policy, it complies with the letter of the law, and has legal and economic substance. Unacceptable tax avoidance has been coined or labeled by the CRA as aggressive tax planning. CRA gets excited, and I used to work for CRA, so I can get excited here too, but they get excited on things like treaty shopping, surplus stripping, and loss trading in an arm's length context. That's just to name a few. But Canada has a GAR, which the UK doesn't, so we're maybe a little bit ahead on that aspect with the UK. So what I'd like to ask John right now, and this is an opening, maybe a sucker punch to John here. it's a loaded question on what do you think, John, as a tax policy guy, what aggressive tax avoidance or tax planning is?
Thank you, Mark. Good morning, ladies and gentlemen. I'm delighted to be here, even though I don't follow the national sports of Canada. It's nothing like being given a nice, easy question to start with. I have to start off by saying, if you're sitting up here, I can't see any of you because these lights are so bright, I can actually only just about see these guys. When they invited me to come up and speak, I didn't realize they were going to be torturing me into doing it. Anyway, aggressive tax planning. I mean, the short answer to that is there is no definition, and I'm genuinely not going to try and define it here. What I will say is that it means very different things in very different parts of the world, and indeed the entire tax avoidance debate is very different in very different parts of the world. I mean, those of you that have been following the press in the United Kingdom will be aware of just how vitriolic some of the debate has been about some tax planning, which I'll come on to, which I don't think many of us in this room would regard as particularly aggressive at all. What I am clear about is that the entire subject has moved on from where it was 10, 15 years ago. I mean, when I started in this business, which I'm disappointed to say was over 30 years ago, you know, it was pretty clear that, you know, what was acceptable was as long as you were within the law, as long as you made full disclosure, that was acceptable planning. And I think back to some of the planning that I did in the early 90s, and it fell into the unbelievably aggressive category to the extent that this is not planning that, frankly, we would do today. Not because it's illegal, but just because actually it just wouldn't pass the smell test of planning that any of our clients would be prepared to do. It's therefore gone further, in my view, than simply unacceptable tax shelters. Precisely where that line is drawn will depend upon what attitude each company has, and we'll talk about that, and where you are in the world. If you're in Asia, for example, as many of you will know, this debate isn't really happening at all. But you know, if you go into the United Kingdom, if you go into most of Western Europe, even the United States, this is a very hot topic, and as I'll say in a minute, I don't think it's going to go away. Let me just give as an example of what I'm saying. Many of you will have been following the situation of Starbucks in the United Kingdom. Starbucks, along with a number of other companies, has been subject to huge media scrutiny in the UK because it pays very little corporation tax in the UK. Or I should say, by the way, I know nothing about Starbucks other than what I've read in the newspaper. So everything I'm saying is stuff that is just in the public domain. They are, as far as I can tell, being criticized for not having significant corporate profits for three main reasons. The first one is that it appears they have a number of loss-making branches in the UK, and successive governments in the UK have maintained a policy that they want to have very free and generous loss offset rules. The second point is that they do have interest that they are paying, and the UK has, as I'm sure you know, quite generous interest relief rules. And that is a policy that has been maintained by successive governments, again, over a number of years. And thirdly, they are paying a royalty to an offshore company for the use of the Starbucks name. Now, it is alleged that that royalty is somewhere between 4 and 6%. I am not a transfer pricing specialist. I have no idea whether 4 or 6% is right. I do know that if I set up John Preston's coffee shop in the middle of London, people wouldn't be paying me $4 for a cup of coffee. So I don't know what the right royalty is. It doesn't surprise me that there is a reasonable price that has to be paid for the use of the Starbucks name. Now, you can debate this in all sorts of ways. You can argue about, well, is it right that the name is apparently being held, according to the media, in a jurisdiction which has a low tax rate? You could argue, but is it acceptable that a company is doing business in the United Kingdom? It has apparently very large turnover, but it's not contributing to the tax base. I would argue very strongly, and the total tax contribution analysis that we do, I think, demonstrates that companies pay far more tax than just the corporate income taxes they pay, and I think it's right that governments should look at those. But nonetheless, the focus at the moment does seem to be on their corporate income tax. But if you just think about those three elements, I don't think anybody in this room would describe any of those as aggressive tax planning. But the CFO of Starbucks got called before, excuse me, the Public Accounts Committee of the UK House of Commons and was hauled over the coals for what was unacceptable planning. I don't think anybody would have said that was unacceptable. So I just think we need to recognize that's the issue. But the crucial point I want to make is there are a number of people who believe that this debate is going to go away. If we ignore it, it won't happen. I'm afraid I simply don't believe that's true. I recognize, for example, that in Canada, you haven't had this debate particularly strongly as yet. My view is that it's a question of time, and this will be coming to a media outlet somewhere near you at some time soon. And the reason for that is you have to think about the backdrop against which this is happening. Just about every Western government, Canada has done significantly better than most, but most Western governments are desperate for money, and everywhere the talk is of austerity. The stated reason for that is that governments need to pay down debt, but actually I think that's a consequence rather than the cause. I think the cause is that most Western governments, and some governments elsewhere, but it's particularly true of Western democracies, have made promises and raised expectations of their population that simply cannot be afforded in the medium to long term, given expected growth rates. The result of that is twofold. Firstly, the population are not going to get the benefits and the pensions that they've been led to believe, and in relation to pensions, certainly not at the age they were led to believe. And a number of countries, including the UK, are already starting to raise their pension age. And secondly, I think everyone of my generation will look at our children and look forward, hopefully, to our grandchildren, and will come to realize that our children taken as a generation are going to be less well off than we are. And that is very hard for people to take. The result of that is that I believe populations and therefore politicians will very understandably continue to look for the magic bullet that will solve this problem. And the obvious targets are going to be rich individuals and large corporations, of whom it is going to continue to be said, if only they paid the right amount of tax, this problem would go away. Now, everybody in this room understands that even if you taxed the rich, whatever that means, to 100%, and you taxed companies at 90%, it still doesn't raise enough money. The tax base just isn't big enough. But the attraction of this point to politicians is huge. The consequence, I'm afraid, is I don't believe this issue is going away anytime soon. I think it is affecting policymakers, and I think we just have to learn to live with it.
And John, just to add one point on that, because I think that very well describes the global environment that we're seeing around the world in terms of the tax administrations looking at what is global aggressive behavior, looking to raise revenue. But the reality is that corporates are constantly under pressure in an increasingly globalized world to be competitive. And so the boards, the tax executives, the operating people within the corporates are constantly looking at locations for labor, locations to be, for their supply chains to be structured in a more efficient way. And as corporates around the world restructure their operations to move risks, functions, and assets to different locations to be competitive against the competition, this, I think, is also contributing to this environment of what's called aggressive behavior. Corporates have this pressure on the one hand, and governments have the pressures that you've alluded to, John, on the other. And I think it's making for a very volatile environment, and that's likely to continue.
I think that's a great point. I agree with you.
John, thanks. Let me drill down a little bit more on tax avoidance, John. What's the reaction of the policymakers when they're debating governments about tax avoidance? What's the reactions there?
Well, and again, it is slightly different in different parts of the world, but certainly when you talk about the Western world, it is clear that policymakers aren't being affected. I mean, only 2 weeks ago, we had the finance ministers of the G20 calling upon the OECD to strengthen tax standards. We've had the UK and Germany UK and Germany, can you imagine two more unlikely bedfellows? But the UK and Germany have actually agreed that they will jointly have a crackdown on avoidance by multinational corporations. You've got the EU looking at things such as double non-taxation and the use of tax havens. You've got France raising its personal tax rates to 75%. And you've got a huge number of countries, including the United Kingdom and even the United States, looking at the introduction of general anti-avoidance rules, such as Canada have got. So there is a significant trend for policymakers to look at this. But it's not just Western Europe. I mean, countries in India, Brazil, China, they are all looking at avoidance techniques and ways of trying to mitigate it. I suppose the other observation to make, just as a slight digression from the pure tax avoidance question, is they're also reacting by moving from direct to indirect taxation, because there is a perception that indirect taxation is harder to avoid than direct taxation. I mean, if you go to China, more than 50% of China's revenue already comes from indirect taxation. And increasingly, we are seeing governments raising a greater proportion of their revenue from indirect taxes, environmental taxes. Although environmental taxes have been perhaps less in the media spotlight over the last few months, it continues to be a trend that we're seeing. I mean, even the United States, I mean, I was in Washington a couple of weeks ago and we had some meetings on the Hill. And it is clear that even in the United States, there are some serious policymakers who are beginning to think about, heaven forbid, the possibility of a goods and services tax. Now, I'm not suggesting the US is going to get a VAT anytime soon, although we may get time to explore this later. In my personal view, it's about the only way, and certainly the only effective way, of dealing with their fiscal problems. They just can't get past the political difficulties of introducing it. But in most other countries, the problem with indirect taxes, VAT, goods and services taxes, is that they're regarded as regressive taxes. The problem is that I think the regressivity should be dealt with through the benefits system and not the tax system. Because if you deal with it through the tax system, you end up giving tax benefits to people who frankly don't need them. Let's take the European Union and the low rates of tax that are applied to politically sensitive items. In the UK, for example, children's clothes are zero rated for VAT purposes. Now, that does give a benefit to lower income families. It also, though, gives a tax benefit to higher income families who frankly could afford to pay the tax. And in the medium term, I don't believe that those tax benefits are things that the tax systems can continue to afford in an environment in which austerity is happening. Now, New Zealand, with its much purer form of VAT, has shown what can be done. So I think there is a trend that's going to continue in that respect.
All right, thanks, John. Now, that was the policymaker side of things, but let's not forget the tax administration side. What are they doing to fight back, and how do the tax administrations work maybe better together to combat aggressive tax planning?
I think it's very important to distinguish the two, and you're quite right. I think they're cooperating in a number of ways. The first point to note is that they are cooperating. And in addition to bodies such as JITSIC, with which we've all been very familiar for a long time, we are starting to see a much greater degree of exchange of information between countries. Even countries that were previously regarded as impenetrable and tax havens, like Switzerland and Liechtenstein, have actually agreed to some form, they're not pure exchange of information agreements, but some form of loosening of their secrecy rules over the last sort of 12 months or so. And partly that's a result of pressure. Partly it's a result of a desire genuinely to improve their standing. But in addition to things like that, what we are seeing is that the exchange of information bilaterally between tax authorities is increasing dramatically. And the message, I think, for all of the companies in this room is you need to recognize, as I'm sure many of you do, that you have to assume that any information you give to any revenue authority anywhere in the world will be shared more widely. And that means that your tax people around the world need to coordinate even more closely than they have done in the past. I'm not suggesting for one second that anybody in this room would be deliberately attempting to hide anything from a revenue authority. But we all know that the way in which information is conveyed can make a huge difference. For example, if you were to say to the tax authority in country A, that they shouldn't be concerned about a piece of tax planning you did because it wasn't designed to avoid tax in country A, it was designed to avoid tax in country B, that is likely to give you a very serious problem in country B, especially if they have just introduced a general anti-avoidance rule. So, you know, this sharing of information, this cooperation that we're beginning to see is a trend that I believe is going to continue. We are seeing it spread much beyond just the sort of main developed countries. We're actually starting to see this spread into other countries in Africa and Latin America and so forth. So the old idea that these guys didn't talk to each other, I think, is gone away.
Okay. David, do you want to say?
Yeah, I can't let that pass without just commenting that there's no question, as you indicated, John, that there's a much greater flow of information and cooperation. This does not necessarily, and you're not implying this, but it doesn't necessarily lead to agreement on substantive issues. In many cases, it's a zero-sum game, and the two jurisdictions are going after the same dollars or the same yen or the same euros. And so therefore, cooperation doesn't necessarily mean that they're in agreement on some of the difficult issues that we face today. And so it's a very interesting environment, I think, that we have right now. It's, to some extent, it's like playing poker with a person across the table and constantly showing your hand. But you both want to win. And so you're constantly trying to cooperate, share information, but each side has an objective that it's trying to achieve. You alluded to raising revenue and the need to do that, John, for many reasons. And so at the end of the day, after sharing the information and understanding the facts and economics and law, at the end of the day, there are individual country fiscs that need to be protected, and I think it leads to some interesting controversies that we'll talk about in a while.
Great. Thanks, David. So John, we have a lot of people in the crowd here that they're all TEI members generally. They're large corporations and very large corporations. We've talked about aggressive tax planning policymakers and tax administrations. We're right around the bend with Christmas, John. So how do you wrap all this in a nice package? And in other words, what should companies do when we're talking about aggressive tax planning today?
I think there are two things that companies should do. The first one is that I believe every company should have a policy in relation to the tax planning that it is prepared to undertake, which should have been discussed with and understood by the main board, and the company should be prepared to explain that policy in public if necessary. If the company isn't prepared to explain that policy in public, then I have to question whether it's the right policy. I think the challenge here is that the need to be able to explain in what way you'll do this has become increasingly important. Now, it's perfectly valid to say that your policy is that you believe the only obligation you have is to maximize returns to your shareholders, and therefore you will do any planning provided it's legal. That's a perfectly valid policy. Personally, I would say that these days companies owe responsibilities to a wider range of stakeholders than just their shareholders, but that policy is fine as long as the company has thought through the implications of that policy. And the chief executive recognizes that it could mean that his company has a negative headline on the front page of the Wall Street Journal or the London Times. If that's the case, then every stakeholder, be it a customer, be it a policymaker, be it the revenue authority, a shareholder, will engage with the company knowing exactly where it stands. But, and this is a very important point, it is important to note that I am not aware of any company which has been the subject of one of these publicity campaigns against them which has seen any significant change in their customer buying behaviors as a result. Now, you have to ask how long that's going to be the case, because at some point, people you think are going to wake up to this. But at least so far, there hasn't been that consequence. Even, excuse me, even companies which have seen their premises occupied and things like that, that hasn't translated into customer action as yet. But I'm afraid I do think it's a question of time. The second thing I think companies should do is just engage in the debate. So much, and by that I don't mean necessarily that all of you have to engage publicly through the media, but I do think you need to make sure that your representative bodies, that your industry bodies, and you yourselves, when you have an opportunity to engage with policymakers, should do everything you can to get the true facts and data out there. So much of this campaign, this data, is based on just plain bad facts and misunderstandings, that I think we all have an obligation to try and make sure that the right data gets out there. You know, I recognize there are some people who just don't want to listen to the facts. They regard, you know, big business as just plain evil. But in my experience, the vast majority of people do want to engage, they do want to understand the facts, and you can have a sensible discussion with them. And there's one crucial fact that I think we ought to be getting out there, and that's the responsibility that governments bear for the current issue. The simple fact is governments do compete with each other, and tax is a key part of their competitive armory. And it is hardly surprising if companies try and take advantage of tax regimes which are deliberately set up to encourage them to behave in certain ways. I was telling a couple of people yesterday that there was a fantastic case in the UK about 2 or 3 months ago, where the British Prime Minister was talking about some individuals who'd engaged in aggressive tax planning, and he condemned them as being morally repugnant. And then on the same day, he went on to say that any individual in France who wanted to escape the 75% personal tax rate by coming to the UK would be welcomed with open arms. And he honestly didn't seem to understand that there was any irony in those two statements at all. So, you know, if governments deliberately set out to attract companies or individuals by behaving in certain ways, then if they don't like the consequences of that, then it is for governments to start to work together to deal with some of those issues, rather than challenging companies who actually, by coming to individual territories, are creating jobs and wealth, and actually doing exactly what the governments are encouraging them to do.
Good. John, there's, you mentioned about 9 minutes and 30 seconds ago the term tax haven.
Yes.
And when I think of tax havens and aggressive tax planning, they're husband and wives, yin yang, they're one or the other. How do you see tax havens in the global tax planning strategy? And here's the tough part of my question, John. I'd really like you to try and keep it to 2 minutes on this one. It's probably not fair because I want to go to tax policy soon. Can you just touch briefly on that?
Yeah, I think the key point about tax havens is that it is getting to the stage where countries themselves are beginning to be much more sensitive about their reputations. And I think all of the people in this room will find that some countries are going to become more unacceptable than others as a place to have your business. And you will face a greater level of questioning from stakeholders about why you have subsidiaries in particular locations. And I know that this is beginning to affect the havens themselves. For example, I know from personal discussions that both Luxembourg and Irish governments are particularly concerned that their countries do not get seen as unacceptable places for multinationals to do tax planning.
Yeah. I honestly can't believe John did it inside of 2 minutes. He could have spoke on that for an hour or so. John, since you did well on that question for timing, I'm always curious to know your views on the OECD and the influence of the OECD, whether or not it's declining. And what I'm trying to get at here is I'm referring to the breakdown of international tax norms. And again, they're not fair, but I'll give you 3 minutes because you did well on the last one.
Thank you very much indeed. Actually, I think you've identified one of the most worrying trends in international tax today, because I do think that international norms of behavior, which I suspect everybody in this room has grown up with and probably takes for granted, are starting to be challenged. I mean, one example is the attempt by countries to tax transactions involving the sale of shares of countries which are not resident in their territory, but which have very large subsidiaries in their territory. The attempt by the Indian government to tax Vodafone was a particularly egregious example of this, but they're by no means the only country that are going in that direction. China are trying to do it as well. Now, it is perfectly appropriate for governments to seek to tax that sort of transaction, provided that they do it prospectively so that investors and companies know what the rules are going to be when they make the investments in the first place. A more worrying trend is the challenge that is arising to the arm's length principle of transfer pricing. Because, as you know, although everybody in this room, most people I suspect, would agree that the arm's length principle is appropriate and, whilst it's not perfect, is certainly better than all the alternatives. The problem with it, the arm's length principle was designed by developed countries to reward the providers of capital in the broadest sense, risk capital, financial capital, and so forth. Now that's fine, but if you're a developing country in sub-Saharan Africa, for example, it simply doesn't give you enough money. And the result of that is that we're starting to see very significant tensions between particularly the OECD on the one hand, which is seen as representing the developed countries in this argument, and the UN, which is seen as representing the developing countries in this debate. And the result of that is that I think we are seeing that the previous dominance that the OECD had in setting standards of tax behavior is beginning to decline. It's not going to go away, it will remain a very important body, but I don't think it will have the dominance that it used to have. I mean, the work that the OECD is doing looking at intangibles is an attempt to try and deal with that tension. But, I mean, there was a meeting on it last week. It is very clear that firstly, that's going to find it very hard to come to an answer, and even if it does, it is going to be far from satisfactory. So that sort of breakdown, looking at, threshold permanent establishments is another example. So we do need to be conscious of that sort of breakdown.
John, now, thank you, and maybe switching gears to tax policy. As you know, Canada has been putting more and more focus on cross-border transactions, on transactions that are perceived to be eroding the Canadian tax base. We're talking about, debt push down, upstream loans, thin cap issues, secondary adjustments to transfer pricing. I can go on and on. Do you see the Canadians' tightening trend here something that's being considered in the UK or other countries?
Yeah, it goes back to the point I was making earlier on about the need for cash. So the natural reaction of every government when they are short of money is to say, well, there must be loopholes we can close, there must be ways in which we can raise more revenue. So most countries are looking at ways in which they can close what they regard as loopholes, whether we would describe them as loopholes or not. I mean, for example, in the UK, the fact that you can pay a royalty outside the UK is regarded as a loophole. I think most of us probably wouldn't think about it that way, but that's the way it is. And the result of that is that you're increasingly seeing pressures on companies. You're seeing much more aggressive behavior by revenue authorities in trying to challenge things, and they're doing it in very aggressive ways. I think it's important to note, though, that governments remain schizophrenic. So I've talked about the UK, I could talk about others, but just to use the UK as an example, notwithstanding everything I said earlier on about the UK challenging royalties and everything else, they have had a policy for about 15 years amongst all political parties to try and make the UK tax system more attractive and have it as something that will be attractive to companies to come and base headquarters there. And they have done a very good job, I have to say. Over the last 20 years or so, they've sort of, we've moved to a participation exemption, we've got rid of ACT, we've just changed our CFC rules to make them much more friendly. But that sort of schizophrenia is something that we're seeing matched in a number of countries around the world.
John, I always wondered about countries trying to get the big prize, the big star on their lapel of having the lowest corporate tax rates. Do you see that trend leveling off? Is it declining, that trend, or what's going on with corporate tax rates globally?
Again, I think it's a very timely question. Many of the people in the room may be aware that PwC does a joint study every year with the World Bank called the Paying Taxes Guide, looking at the ease of doing business in 187, I think it is, countries around the world. And one of the areas that we focus on is the ease of paying taxes and the rate of tax. And although the company that we use as the example is a sort of hypothetical model company, the really important point is not necessarily where each country comes in the rankings, although you'll be pleased to hear Canada does very well. But it's the trend that you can see. We've now been doing this for 8 years, and therefore we're seeing some very interesting trends. This is particularly topical because it actually gets published tomorrow. So I will give you a sneak preview. There are a number of trends that were identified, but I'll mention 2. The first one is exactly the point you've just made, that the so-called race to the bottom for corporate tax rates around the world does not appear to be happening. There has been a debate for a long time, as you know, that eventually all that will happen is that tax rates will sort of veer towards 0. That doesn't seem to be the case. The tax rates seem to be flattening out, and they seem to sort of be collecting around a sort of norm point. And I think that is right, because when I think about, say, London against Dublin, Dublin has a significant lower corporate tax rate, but there are significant reasons and advantages why people would rather be in London than Dublin. And therefore, my view has always been that people will pay a premium to be in London. The question is, how big is that premium? And that is true everywhere around the world, even within the individual states of the United States. There is a question of how big is the premium. So, I think that's the first trend. The second trend that's coming out of it, which perhaps is intuitively obvious, is that those countries which have spent time and effort in trying to reduce the administrative complexity of their tax systems seem to be seeing a significant level of enhanced growth as a result. You can argue about the cause and effect of those things, but intuitively it does sound right, and it is certainly borne out by the facts that those countries which have tried to simplify the administration of the system get at least as big a benefit as those that try and reduce the rate.
All right, I think I'm going to make a call here. I had another question for John, but I think I'm going to put John on the side for now. I feel David really kind of anxious to get out of the gate here, and you've been more than patient, David.
I'm not going to leave the room.
And those who know David, he's very passionate about what he does. David, what I'd like to do with you this morning in the next half an hour or so is touch on 4 broad areas: risk assessment, audit trends, things going on in the IRS administratively, and maybe a few technical issues I'd like to bounce off you. So if I just touch on risk assessment. In Canada, everybody in this crowd must know that the CRA is in full gears on risk assessment. We have 1,100 large corporations in Canada that have already been risk assessed. The thing is that the Revenue Authority in Canada has not had the interviews with the 1,100s. They finished their first phase, the 50. I was told a couple of weeks ago in a conference at the Canadian Tax Foundation that there's now in phase 2, which is 100 taxpayers, and they're going forward. And you think that they're going to be in line to complete all the interviews within the next 3 years, which would make them their 5-year time period, because it started 2 years ago. David, to get you warmed up, what's going on with the IRS and other countries on risk assessment? I'd like your comments on that.
Well, I think if we look at this sort of as a logical progression, Mark, from risk assessment, identifying targets, to what are the audit techniques, to what are the dispute resolution alternatives that we see around the world. The beginning point is always something that we refer to as risk assessment. Another way of using that term is to think of it as profiling or targeting corporates that'll be under audit. And in the PwC Paying Taxes publication that John mentioned a couple of years ago, we did a survey of, I think at that time it may have been about 175 or 180 countries. And the question was asked of all of those countries, how do you target, how do you identify corporates for audit? And the overwhelming response, the #1 response was, if they seek a refund of taxes. If they seek a refund of taxes, we're going to audit them if they want money back from us. Number two was the size of the company, just as really sort of as unsophisticated as that, just the size of the company. But most countries now are moving in the direction of very sophisticated matrices that analyze a wide variety of factors to determine which companies, which corporates should be under audit. The UK has led in a lot of these areas of risk assessment. Canada, you mentioned, Mark, as well, and the US. And among the factors that they look at are, in the United States, a tiering issue program where major issues were put into 3 buckets. And if a corporate had issues in the first bucket, the highest profile of risk, cost-sharing agreements, for example, transfers of intangibles, they would be audited. The IRS has recently announced that it is eliminating this tiering system after several years of trying to make it work. It was very controversial, and is moving away from that. And I'll talk about the new system later. But what I wanted to say is that the U.S. now is looking at a wide variety of factors, as I think other countries are, including not only the issues that come into focus, but the industries that are involved, the size of the revenue or turnover attributable to certain industries. The category of inbound corporates is receiving a great deal of attention, and also looking at the question of loss operations for those inbound companies. The pharmaceutical industry, the high technology industry, the automotive are all receiving a lot of attention as risk assessed. One of the things that you can do in the U.S. now is, when an audit commences, ask for the risk analysis of your company, and the IRS will actually give it to you. So it will identify the areas in its risk assessment that the IRS has focused on and what it thinks the possible exposure is in that area. And sometimes it's shocking. Sometimes you think the issue would be risk assessed by the IRS at hundreds of millions of dollars, and it's a fraction of that, or the other way around. The IRS, of course, is not bound by the issues that it identifies or the dollar amounts that it attributes to those issues, but it's an interesting aspect of the risk assessment approach that we're seeing in the U.S. Australia also has led in this respect with many of the same factors that we're talking about. So I think the bottom line is that more and more countries are going to a sophisticated matrix approach that attempts to balance a wide variety of factors to determine which companies should actually be under audit.
Leading from there, David, I noticed that reading a lot of the summaries of the Forum on Tax Administrations, where a lot of the head of tax administrations gather on a yearly basis. They're trying, obviously, to work more and more together, these tax administrations. And I know that there's joint audits that are being considered, and I'm aware of at least one case where there is a joint audit between Canada and the U.S. tax authorities. Could you shed some light on that, David? And in answering that, maybe you can tell us, what do you think that the tax administrations are trying to achieve here? And maybe a sub-loaded question here, how can one prepare for one of these audits?
Well, the newest trend in audits is what you're referring to, Mark, is joint audits. The Forum of Tax Administrators prepared a paper several years ago, a very thoughtful paper on this. I think it's 65 or 70 pages of analysis of what is a joint audit, how it should be conducted. And you may say, well, why is this new? Simultaneous audits have been around for 20 years, and they have. But there is, semantically, they may sound the same, a simultaneous audit and a joint audit, but they're really very different creatures. The simultaneous audit is where one or more countries are conducting their own individual audits of a corporate and are operating independently. They may share information to some extent, but their audits are progressing perhaps on separate issues at a separate pace. But the idea of a joint audit is that two countries would come together and create one audit team, one team, comprised of auditors from both jurisdictions to conduct the audit on a real-time basis. A lot of advantages are articulated for both corporates and tax administrations with joint audits, and a number are underway now, at least one between the United States and Canada, another between the United States and Australia, and one between the US and the UK, all for the most part English-speaking countries, and therefore some of the administrative problems of translating documents, interviewing individuals were seen by the tax administration as being easier to start with those countries. I think that the early results are mixed. I think there was early success with a joint audit for a UK-based company. And as I understand it, we're involved in the one with Canada. It's progressing pretty well. The one with Australia, I think it's mixed, because at the end of the day, you may have one audit team jointly auditing the corporate, asking questions, interviewing, but as I mentioned earlier, there is one pool of profit that they are attempting to tax. In these transactions, there's no tax haven in between. In fact, some of the largest controversies I've been involved in my career are between high tax countries, the US and Japan, the US and Germany, the US and Canada, the US and Australia. So there's a lot of rhetoric, as John spoke to, about aggressive tax planning and the use of places like Switzerland and Ireland and Singapore. But some of the most contentious cases are between two relatively high tax countries. And I think that in some of these cases, as the audit teams start to develop their positions, you find that they are at odds at what the fundamental principles are that they're applying and how to value risk and function. And that can then lead to a controversy between the two administrations. Now you might say, well, that's good, because the controversy would eventually emerge under the normal system into a competent authority or MAP case 3 or 4 years down the road. So aren't you accelerating this process? And isn't that to the benefit of the corporate and to the countries involved? And I think the answer to that is yes. It's just that it can be a very difficult exercise in trying to, in essence, serve two masters in answering the questions, providing the information, and participating in the broad number of interviews that are required sometimes. So I think it's a mixed result right now. In terms of the last point you asked, Mark, I think it's very important for corporates to develop consistent positions, consistent theory of the case, and a consistent story. Because the old days of arbitraging positions and facts between different governments is absolutely gone. Now, with transparency and cooperation between the governments, there's absolutely no question that the facts and the positions will be developed either on a real-time basis or in the normal process of an audit.
Yeah, I appreciate that comment, David. I worked in a public company in the 80s, and we had stories depending on which tax authority we were talking about, and I think that transparency has created a consistent message that are to be given by corporations on this. You've mentioned joint audits, David. You've mentioned simultaneous audits, and you touched on real-time audits. Is there a trend on real-time audit that is going somewhere?
Yeah,
or is that a thing of the past?
I think a lot of these new programs, whether it's joint audits or real-time audits, are new and developing trends, and the jury's still out as to whether they're going to work effectively or not. We did a survey of 25 countries around the world asking our PwC offices, does your country have streamlined audits? Do you have that? Most of our colleagues said, what in the heck is a streamlined audit? And we explained that, does the country have a system that allows you to either accelerate an audit or focus on a limited number of issues? And over half of the 25 countries that we surveyed said that they did have some form of streamlined audit. The reason this is important is that corporates are facing an increasing number of audits around the world. We have one corporate in the United States that has 329 audits underway right now. There's a large listed Australian company that has 280 audits underway around the world. Indirect, transfer pricing, non-transfer pricing. That particular corporate has 60 audits in Brazil alone. And as the number of audits increases around the world, it's extremely important to understand whether there are processes and procedures that allow you to accelerate the audit, focus only on the important issues, or otherwise streamline the process. And so I think that a lot of times the rhetoric surrounding things like joint audits and streamlined audits, no one can really disagree with the potential value. But then, many times the real world sort of comes into play. In the United States, the IRS has been pushing the CAP program for a long time, the CAP, the Compliance Assurance Program, for a select number of corporates in the U.S. And the idea is that the IRS and the corporate will agree the issues in the tax return before it's ever filed. So there'll be no need for an audit after the tax return is filed, because there'll be a real-time audit, if you will, before it's filed. And I think that again, from what I understand, and we're involved in a number of these audits, it's has mixed success. For a lot of corporates that don't have some of the more contentious issues that we see, the system seems to work fairly well. It does require a commitment of significant resources by the corporate, and upfront planning and real-time cooperation and transparency at a level that we've never seen. But our experience also is that if a corporate has very difficult, complex issues, that it is not possible many times to resolve those issues within the CAP program. And so the issues then go on to the next level of the controversy process, whether that's administrative appeals or some other form. And some corporates say, well, why did I enter into this program when my most contentious issues can't be settled before the tax return's filed? Others say, well, even if we narrow the universe of issues down to just one or two, and we can't settle them, it's still to our advantage to try to move forward with this type of real-time audit.
And sorry, just to make the point, Dave, we both sort of talked about that and the fact that revenue authorities are becoming very aggressive in the way in which they will challenge particular issues. I don't think that's inconsistent with the other trend we're seeing, which is a general principle. Revenue authorities around the world are trying to have better and deeper relationships with corporate taxpayers. And they do seem to have a sort of relatively schizophrenic approach of, on the one hand, saying we want better relationships, but on the other hand, we are going to be very aggressive when we find things we don't like. And actually, I don't think those two things are incompatible. I just think that's a way of life that we're going to have to get used to.
And I said recently in a speech that it's, on that point, John, it's balancing across-the-table cooperation with aggressive enforcement, trying to find that balance between enhanced relationships that the UK has led with and across-the-table cooperation. At the same time, aggressively auditing is a difficult balance. In the United States, I would say that the audits, so despite the CAP program and a number of these new features, we have a program called LIFE, Limited Issue Focus Exam, where the IRS looks only at certain issues. Despite that, the IRS is involved in very aggressive audit strategies. The IRS despite budget constraints, is sending its auditors around the world. And in my years of doing this, I've never seen the IRS at the level, engaged at the level it is. Of course, if a case was being litigated in court, both sides pull out all the stops to do whatever it is to win. But at the audit level, before it's known whether an issue will be litigated or not, the IRS rarely sent its employees to China, to the UK, to Switzerland, to Germany, to conduct interviews in those countries of the nationals of those countries. You might say, well, Dave, I thought it was against Swiss law for there to be an interview of a Swiss national by a foreign official, and the answer is yes, but the world is changing. And we are seeing aggressive, what I would call, and maybe aggressive is too much of a pejorative term, but very focused audit activity in interviewing, using outside independent experts, and with the budget constraints, spending the money for retaining experts, extensive IDR requests, and even the threat of summons enforcement in court if the information doesn't come. So it creates a somewhat schizophrenic, to use your word, John, environment where corporates are trying to cooperate with the IRS, but at the same time, many of them are under these intense examination processes.
David, what I heard in the last 5 minutes is when you said something that one company has 300 audits going on, and after that, my brain just shut down. And, and with all these controversies going on worldwide, David, what are the effects, pressures on tax controversy and dispute resolution alternatives? In other words, what are the tools in your toolbox, David, when we're looking at all these controversies?
Oh, Mark, I think that's a great question, and at the end of the day, this is what it's all about. We can talk about risk assessment approaches and what corporates the governments are targeting. We can talk about the techniques, streamline joint audits, but what are the practical effects of this environment? And I can tell you what we're seeing is that historic dispute resolution alternatives are coming under unprecedented pressure. And in countries that have administrative appeals as a way to resolve disputes, the inventory levels are at record highs. The OECD just released statistics showing that there's been a 41% increase over the last 3 or 4 years in competent authority or MAP cases. So many of you, corporates and advisors in the room, have complained for years that the competent authority process takes too long. 3 or 4 or 5 years to resolve a case is too long. In some countries, 15 years is too long, But as the inventory rises, then, and governments are strapped for resources, human capital resources and financial resources, it's putting an enormous strain on the system. I think equally important is the fact that governments are adopting what I would call divergent positions. I once said they were adopting unprincipled positions, and I was chastised about that, so I won't say that word again. Some governments around the world are adopting divergent positions, and what I mean by that is exactly the point that John alluded to earlier. When many of us were in school and understanding what a permanent establishment is and was, there were only a couple of ways under most treaties to have a permanent establishment, but the definition and the scope is expanding. John referred to indirect stock transfers in transactions that most people would say would never be taxed. The Vodafone case being a primary example, we looked at about 20 other countries and asked the question, in exactly the same factual scenario, would you tax this transaction? And all of them said no, except China and its circular 680 may tax that transaction. But as the inventory level rises and as countries take divergent positions, it creates a very difficult environment to resolve these disputes. Now, one alternative that's emerging is mandatory binding arbitration as a new approach. You might say, well, Dave, arbitration has been around since the mid-1990s in the EU. There's an EU convention on arbitration, and that's certainly true. But what we're seeing now is a move, at least in the United States, toward this concept of mandatory binding arbitration. We call it baseball arbitration because it was developed based upon the negotiations between Major League Baseball players and the Major League teams. There's always a winner and a loser in the arbitration in Major League Baseball, either the player or the team. The arbitrator cannot accept a middle position. He or she has to decide on one of the other positions. You either win it all or lose it all. And our arbitration provision in the treaties with Germany, Belgium, Canada, and France have this provision in it. And there is some evidence that the arbitration provision is having a positive effect. It's been reported publicly, I think, that over 80% of the cases between the United States and Canada that were eligible for arbitration were settled before going to arbitration. And that of the remaining cases, only a handful or less have actually proceeded to arbitration itself. And when arbitration first came in the German treaty in 2006 or 7, and it takes a while for these cases to move through, we said that arbitration, the success of arbitration will be judged not by how often it's used, but by how seldom it's used. Because if it's having an effect of moving the competent authorities closer together and therefore they're resolving cases quicker and more efficiently without the need of going to arbitration, then the concept has worked. We only have 4 treaties with this provision, and I think there's some question about whether other countries are interested in entering into these kinds of provisions, because it certainly does put a lot of pressure on the administrations. And I think, Mark, those are some of the, the newest techniques that we're seeing in resolving disputes.
Thanks, David. And David, I know you're going to be impressed that I really do listen to you. And you mentioned baseball. David has 6 children, one of which is a pro baseball player. So I'm going to, lob a very easy one to David so he can hit it out. And it sounds like an easy question, but I think it's an important one. It has to do with IRS internal restructuring. In Canada, CRA sometimes restructures. I remember when they put the large businesses, international and aggressive tax planning together to be more cost efficient and efficient in delivering their service. David, what's going on with the IRS? And just remember, it's just an easy lob ball here of what's going on in the departments. What are the restructuring, and what is the key initiatives of these restructurings? Well,
I hope I don't miss an easy softball pitch, but
I'm watching.
It'd be embarrassing. There's a lot of rhetoric surrounding the reorganization of the IRS. I think they've done a very good job in several areas. One is a reorganization of LB&I. They're moving away from this very controversial tiering system where issues were put into 1, 2, or 3 tiers. It was controversial for a number of reasons that I guess don't really matter anymore. And the IRS has heard the controversy, listened to the complaints, and moved away from that, and is now moving into structuring something that's called an issue practice groups, which sounds similar to tiering, but is actually quite different, where it involves the resolution of issues either on an industry basis or on a specific substantive matter in a real-time kind of way, bringing the right experts to bear. And they've also created something called the International Practice Networks. Unfortunately, the acronyms for the first one is IPG and the second one's IPN. When we talk about these or refer to them, it gets confusing sometimes. But the International Practice Networks is an attempt to take the most experienced people within the IRS and bring them to bear on certain international issues so that their consistent positions are developed across industries and across the issues. But perhaps the most significant change in the United States in the international arena is the merger of the advanced pricing agreement practice and the mutual agreement practice into what's now called APMA, APMA, the Advanced Pricing Mutual Agreement Program. In the past, simply there were two groups, and the advanced pricing group would do the due diligence and would work up the negotiating position to be used with the other government. And then there would be a handoff of the case from the APA group to the competent authority group. And basically the analysis would start over again. And I think senior level officials in Washington believed that this handoff was inefficient and caused great delays. And so there has been, just this year, the combination of the APA program and the mutual agreement, the competent authority program, into one, so that from the beginning of a bilateral advanced pricing agreement being filed, the competent authority representative, or if you prefer to call it the MAP representative, is present in the due diligence that's going on. And the hope is that the APAs will move on a much more rapid basis to final agreement with the other country. There's been a lot of pressure on this, but something needed to change. And I think the IRS has really tried through this combination approach in what is considered by many the most important issue in the world, transfer pricing and the many subsets that exist under transfer pricing, to try to move this system forward. And this revamping of the IRS, I think, is very important to achieve that.
Thanks, David. We're doing good here. We're at our fourth part that I want to address with David on maybe technical trends. Earlier, I teed up a question for John that basically set it up in the sense that Canada has been putting a lot of focus on cross-border transactions to try and level the playing field, broaden the base, get rid of unintended tax results, such as the debt push down and so forth. And one of them was thin cap. David, I heard you speak over the last few days, and you have a lot of knowledge on this, but I'd like you to talk about the debt equity characterization just that issue on debt equity characterization, and maybe also link in if you see any cases that will kind of muddy the waters in the characterization of these of this concept.
Well, I mentioned earlier when we were looking at risk assessment, Mark, that the IRS, one of the areas that it focuses on is inbound corporates. Sometimes people are cynical about these things and say, focus on the inbounds because they don't have a vote in the elections in the U.S. Of course, that's not really true. The inbounds employ hundreds and thousands of employees all across the United States. So I've never really completely understood that comment. But nevertheless, the IRS does focus on inbound automotive companies, pharmaceutical companies, and many financial services industry and many others. Within that category of inbound, the IRS is really focused on two primary issues. One's transfer pricing, and I won't discuss that. But the other is base erosion through debt equity instruments, financial instruments that are characterized in a certain way to achieve a U.S. tax benefit. That U.S. tax benefit may be an interest deduction, or it might be a benefit that's created by the instrument being classified as equity and dividends paid on that equity, bringing foreign tax credits to the United States. So I understand that the IRS has set up over 200 cases now, 200 cases that you could broadly characterize as debt equity cases. Some of them may be looking at sort of the classic debt equity issue of whether an instrument is debt or equity, or it might be looking at other instruments associated with acquisitions or transactions that are being put in place to generate other tax advantages. There have been 3 recent cases in the United States, one all public, decided by the United States Tax Court, one for Hewlett-Packard, one for Scottish Power, and one for PepsiCo. Taxpayers won 2 of those cases and lost 1 of them. The HP case, the instrument was not characterized and classified the way HP wanted, and HP lost that particular case. But both Scottish Power, which was a case involving an acquisition of a utility on the west coast of the United States and debt and equity associated with that, and also PepsiCo's transaction. In both of those cases, the taxpayers won. Now, what's important about those cases, I think, is that despite the attention that the IRS is focusing on in this area and setting up 200 cases, what we're finding is that the tax court is applying the principles that it has historically applied for the last 40 years in this area. We have anywhere, depending upon the court, anywhere between 12 and 16 factors that the court looks at to determine whether an instrument is debt or equity. And so the good news, I think, for company, the bad news is the focus and how many audits and issues are being set up. The good news is that the historic principles that have been relied on by corporates for many, many years, the court continues to focus on those, and I think there's not a great deal of new law being made. It's really relying on many of the same principles that have existed for a long time.
Thanks, David. Listen, because of time, this is an unfair question for you, David, but I'd like you to just kind of tease the people out in the crowd that transfer pricing is obviously arguably the #1 issue in tax. And within transfer pricing, we have payments for intangibles. And again, Dave, I feel really unfair by asking you to do this in 2 minutes. You can either just hit the highlights or speak really, really fast. So there you go. You got 2 minutes, buddy.
Well, we could speak for 2 hours on this one. And John alluded to the very important OECD meeting, the 4th consultation on intangibles. Am I speaking fast enough?
That's good.
Recently in Paris. So if the #1 issue in the world is transfer pricing, and there are 5 or 6 areas within transfer and pricing that are important, the #1 issue in transfer pricing is the transfer and use of intangible property. And let's put cost sharing to the side, even within that category. But as companies restructure and as they move assets, risk, and intangibles from one location to another, this has become the #1 issue, whether you're the revenue authority in Australia or Japan, Switzerland or Germany, France or the United States or Canada. This is the main issue. And the OECD is trying to agree a set of principles that will apply around the world, and the most recent conference showed as expected, a widely disparate set of views on even the definition of what an intangible is, much less how you should price and value the intangibles. So much more to come in this area, both in terms of audits and disputes, and the OECD and the UN manual on this point.
I can't believe you did that in 2 minutes, David.
If it please the court.
I think for the last 5 minutes, and I'm a real accountant, right? I just make sure it's on the time. But what I like to do here is maybe do a little bit of knowledge transfer. These guys have such knowledge in their areas of expertise. So I'm going to give John and David the following question, and I'll ask you, John, to speak first. I want basically sort of like the Letterman top 10 tax policy things that really hit the radar screen for John. And you're not allowed to do the 10. I'm going to give you 2 or 3. This thing ejects your seat if you go past about 1.5 minutes, 2 minutes. And David, I'm going to ask the same question from you so that these people here have some takeaway on tax policy, 2 or 3 things, and also on tax controversy, 2 or 3 things to walk away from here. John, you want to kick this off?
I will. I'll do it in 2 minutes, but I'll probably do 4. The first one is, I think the debate about aggressive tax planning is here to stay. And I think that is a truth that we just have to come to terms with. I think it is affecting politicians, and therefore the second point that I think we need to do is companies need to engage in the debate. Not just on this, but on all the key topical issues. I think the more we don't engage in these debates, the more we will find that things are done to us. We haven't talked about transparency today, things like country-by-country reporting. But if people are not engaged in these debates, then things will happen to them. The third one is, I think, the move from direct to indirect taxes. I suspect that just about all of you have tax departments, which, like every other company in the world, is geared up to deal with direct taxes. Over the next few years, around the world, in Canada and elsewhere, increasingly you are going to find that the focus shifts more towards indirect taxes, resource taxes, and so forth. And you need to think about the resourcing implications for your teams, apart from anything else. And the final one is the breakdown of international tax norms. That is going to affect all of us for the foreseeable future, and watching out for those things and thinking through the implications of it is hugely important.
I think I certainly agree with all those points, John, and just then shifting over to a controversy perspective, the breakdown in the norms, of course, are going to lead to more disputes and controversies. I think being aware of the environment that we're seeing around the world is critical. TEI frequently puts on these great events in the U.S. and here in Canada and other places. I think being aware of these kinds of this current environment is important. I think perhaps the biggest factor is this. Corporates can no longer be or shouldn't be reactive. They should be proactive. When I was coming up in the controversy area, we were always reactive. We were asked to come in and pull the car out of the ditch. It was going down, they were going to drown, pull them out of the ditch, okay? In this environment, with governments cooperating, as we've discussed, with the divergent positions being taken, I think it's really important for corporates to be proactive. And what do I mean by that? I think you need to build defense, think about defense and build defense at the planning stage, at the transactional and operational stage, and not wait for the audit to occur. You do that for two reasons: so you can develop sensible and consistent policies and be ready for the audit, but also you'll find that that will lead to an earlier and perhaps a better resolution and settlement of the case without the need to going to arbitration or, in the rare cases, litigation of tax cases. So I think that would be the main point I would want to make, Mark.
All right. Well, John, David, I think this puts an end to our opening plenary session. I think that on behalf of your Canadian PwC colleagues and friends, the Tax Executive Institute, and the people out here that came out to listen to you two, I think I'd like to thank you very much for your time, your effort, your insights in your respective areas of tax policy and tax controversy. And I think we should just applaud these guys for their great presentation this morning. Thank you.
Thank you. Thank you.
Thanks.